Hello, I'm Bayani Cruz from The Asset. Today I'm here with Priscilla Luke, Global Head for Index Research and Design for Asia Pacific at S&P Dow Jones Indices. Welcome, Priscilla.
Good morning.
Thank you. Thank you for being here. We all know that smart beta strategies and factor investing is gaining a lot of interest in the Chinese equities market, right? And today we're here to talk about your research on how smart beta strategies work in the Chinese market. But perhaps before we jump into the questions, why don't we start by, can you just explain to us what is factor investing or smart beta and investing in simple terms?
Okay, so smart beta and factor investing are kind of the same. Actually, it is like an investment style. We try to select a portion of stocks in the broad market which have different factor exposure or what we call performance characteristics. For example, the classic one would be like value, momentum, low volatility. And through index investing, normally we do this by using different stock selection method or weighting method to capture stock with different factor characteristics.
Now, which factors work well in the Chinese equity market based on your research?
Actually, we have done some research on the China A market between 2006 to end of 2018. We look at 6 factors, including value, quality, momentum, low volatility, size, and dividends. So we noticed that apart from momentum factor, rest of the 5 factors, they all deliver excess return compared to the broad market. In particular, we noticed that like small cap and low volatility, they deliver very good absolute performance. They outperform the broad market by more than 9% between this period. However, in terms of risk perspective, only low volatility perform with less risk compared to the benchmark. Therefore, balancing our risk and return, we look at risk-adjusted return. We notice that low volatility and dividends are the 2 factors that deliver the highest risk-adjusted return in the China A market.
And which factors underperform?
Momentum. Interestingly, even though in China, a lot of people saying that it's a trendy market, however, we noticed that the trend in China market actually changed quite fast. Therefore, we noticed that using a high momentum index, which normally we balance like every 6 months, did not really capture a lot of risk premium in the China A market.
And which factor-based strategies have worked well in Asian markets historically?
I think dividend, actually, if you look at the Asian market, including Asia market, we noticed that a lot of foreign investors, they do like to invest in Asia for growth opportunities. But indeed, for the domestic investors, there's a high demand on high income strategies, including high yield bond, high yield fixed income, or high dividend stocks. And indeed, dividend strategy has performed quite well in the China A market because there are a lot of high yield play in the China A market. For example, one of our index called Dividend Opportunities, which capture high yield stocks with positive earnings, they had a dividend yield of 6% for last month. And over the long term, they had a excess return of around 9% per annum compared to the broad market, which is very attractive compared to many other style of investing.
Thank you, Priscilla. There you have it. We'll have more of Priscilla later in another video. Meantime, thank you very much for joining us.